Hello and welcome to FinSights, interesting conversations with smart people. This series is brought to you by FinClear, the Australian financial services technology company. If you'd like to learn more from thought leaders in technology and finance, head to finclear.com.au.
Good morning to our viewers, and thanks for joining us. My name is Andrea Marani. I'm the COO of FinClear, and this morning we've got Andrew Ward from Self Wealth and Bradley Kaplan from Easy Equities joining us. Welcome, gents. Thanks for joining me.
Morning, Andrea.
Thanks for having us.
Good to have you, gents. Yeah. We'll start with a bit of a background. I'll just do a quick run through for those who aren't across Andrew and Brad's background. So Andrew Ward is the founder of Self Wealth, which was formed to solve the problem of providing a fair and simple service to Australian investors. Since its beginnings in 2012, Self Wealth was listed on the ASX in 2017 and has grown into Australia's fastest growing flat fee online share trading platform. They also listed a unique SMSF lenders ETF late in 2019 and now account for over 100,000 investors as part of their community in their ecosystem. Bradley Kaplan, fellow South African, is from a JSE listed, Johannesburg Stock Exchange listed group called Purple Group. Bradley is from a company within that group called Easy Equities, which was a fintech startup back in late 2013, early 14, and has since grown to over 500,000 investors on its platform globally. Easy Equities is a low-cost, easy-to-use share trading platform with the purpose of democratizing investing for everyone. To the viewers, we'll jump into it now. But to the viewers, just a reminder: you can post questions at the bottom of the screen. There's a little Q&A box. So let's get into it, gents. What's going on? Why equity trading in particular? What's the attraction? We've seen a significant growth in that area. Andrew, maybe kicking off with you, give us a bit of a flavor what you've seen locally, and then Brad, from an international perspective, what you've experienced.
Yes, thanks, Andrea. Well, it definitely has been one of those watershed years for the trading industry. We've all heard about the Robinhood Phenomenon, which we can touch on specifically in the States and how that's come here in Australia a little later on. But I suppose the numbers speak for themselves. Ever since COVID really kicked in and had an effect on people's mindsets, people's careers, people's incomes. Back in Australia, at least in March, the markets took a major dive down, into the 20%, etc. Social media lit up at that point. Certain people were lost their jobs, and therefore their income was in question. Their wealth creation obviously was also put into question, especially in Australia, where wealth creation, the number one way to do that in the past has really been the property market and entering your first homeowners grant, etc., and on you go on your journey. So put all those things together with COVID in March, that it was sort of a melting pot for young investors, especially the millennials, to look at different ways to do things while they're at home, looking into their computer screens as we are now, on what to do, how to create wealth, and really take some financial control of the situation they found themselves in. Social media, as I mentioned, lit up. The market had fallen 20-30%. There are obviously opportunities in the market, and hand over fist, new people signed up to all the online brokerage, all the online really businesses out there, but especially online brokerages, to the point where the Investment Trend Survey just came out in August, that for the first time in 10 years, there was a significant jump in the number of new people and people reenacting their accounts into the market. Historically, over the last 10 years, been 700,000 active online traders. So people who had at least made a trade once a year over the last 10 years, and it jumped to, for the first time, cleared 1 million. So significant, the fact that it hadn't really done that in 10 years and jumped from 700,000 to just over 1 million. Actively online, participating in the markets, using all the information available to them. Yet again, social networks like Reddit and Facebook and others, which we can talk about, the positives or the negatives of them, have really contributed to this phenomenon. The last time we had a significant jump in the numbers in online trading in Australia was the GFC. So as I mentioned, the last 10 years, the numbers in Australia haven't really changed much. They've gone between that band of 650 to 700,000. But in the GFC from 2008 to 2009, there was a 20% jump. So when people are in a state of crisis, especially a financial service crisis or their own personal finances, they tend to look and try to find other ways to take control, to give themselves some sanity. And they're the two most recent, in recent memory, financial crises we've had, and it's had a significant impact on new users into the market.
There's a few users, a few people out there saying, a lot of it was driven by these, take cash out of your super, the job keeper, job seeker. And yes, that may explain an element of it in South Africa. But Brad, I'm keen to hear your perspective, because you didn't see that as much of a cash handout in South Africa. You're sitting on 500,000 users, and you've also had a massive explosion through this period. So could you take us through what you've witnessed on your side?
Yeah, so I think the need's always been there. The baby boomers are looking to manage and take control of their retirement savings, while the Gen X and millennials are trying to find new ways to do business in this digitized economy. Previously, the access was limited, and that's just due to the sophistication of the products. And it's only really been in about the last decade for tech to evolve and birth these fintechs and provide multiple pathways for individuals to take control of their wealth on their own terms. With the enhanced accessibility and education that fintechs are bringing to the market, it's been one of the main causes of the increased participation in the market. To touch on Andrew's point of the knock-on effects of COVID, people are working from home, they have a lot more time. They're not spending their money on holidays, they're not going to restaurants and bars as much, so they have more money sitting in their bank account. Not earning much interest and looking to do something with their money. And we see that as the perfect breeding ground for individuals, be it experienced or new, to dip their toes in the water and learn about investing and see the benefits that fintechs are bringing to the market. They say that around 15% of people previously worked at home pre-COVID, and they project that number to be around 30 to 50% going forward. So I believe that this environment we find ourselves in isn't a quick trend, and rather a new way of life. I think we're just adjusting to the new normal.
Yeah. And I think also to the point you made there, Bradley, with people having more free time on their hands, that's gotten them into it. But, you're both offering great mobile apps. So one would hope, even though, maybe an element of the stay at home eventually changes, we get back to work, they've still got access to it all the time on the mobile. So it'd be interesting maybe to share with us also the demographics that you're seeing. Have you seen that? Maybe Brad, starting with you this time. Have you seen the demographics change much over time? I mean, we've spoken a lot about millennials. Interesting to hear male, female. Is there anything interesting in those demographics that you've picked up?
Yeah, so I mean, our investors range from newborn, and our oldest investor is actually 97 years old on our platform. So we offer minor accounts, which we've seen is a big trend, where parents are opening accounts for their children and starting their investment journey when they're young. The average age of our clients is 32 years old, and that number is getting younger as more users are joining the platform. So there's definitely younger people in the platform. If you look at the old school stockbrokers, if you want to call that, that's about 2 decades younger than their average age. So it's definitely a younger demographic. Our clients are almost 50-50 male, female, which is really good to see, and we're proud of that. And more than half of our clients are first-time investors. So interesting.
Yeah, that's wow, that is interesting. Andrew, you seeing the same on your side in the Australian demographic?
Yeah, absolutely. I think with at Self Wealth with Myriad, that investment trends splurge as well. When it comes to 60 to 70% of those new numbers have come from the millennials, so what we call sort of the 20 to 35-year-olds. So they're significantly driving it. And as Brad said, to Brad's point, a lot of this is mobile first. I think for the first time with online trading, we've moved from the desktop to the mobile as the premier or the primary source of accessing or doing trading. So the advancement of the tech companies and their tools have really enabled this landslide of people coming into the market. With regard to male-female, we were historically a bit more male skewed at Self-Wealth, at least. What has occurred over the last 4 years, and especially it's been accelerated over the last 6 to 9 months, is the female is caught up as well. And one of the main reasons behind that is I suppose the social proofing of sites and businesses like Self-Wealth and Easy Equities, that a lot of it's driven by referrals. And we tend to find the female cohort do like to take a bit of a trust leap with their friends and their family, rather than the male who may just be headstrong and jump in by themselves. So it feeds upon itself. As more people come into these communities and start trading, they speak to more of their friends, they refer more of their friends. So that has increased the female participation quite a lot, which is very encouraging.
Yeah, that's a really interesting insight. Just the way that men and women behave and the impact it's having on that's. And so building on that then, Andrew, thinking or looking at the younger investor, the approach, you were saying, they tend to rely more on friends and family, and we read that more and more in the press. Where do you see younger investors accessing, tips or advice or research, or how do you see that playing out?
Yeah, it's a double-edged sword, but more and more we're finding that we have to play where they're frequenting. The likes of Reddit, Facebook, there are certain threads that are set up. They're fairly easy to find, but they seem to be two of the main mediums that we find investors talking and chatting, positive and negative rhetoric about different stocks, which is dangerous in its own right. We can talk about that in a second. But I think it's mandatory that online businesses need to be present and responding to both positive and negative criticism in the language that the investors are using. So the millennials speak in a different way, and they sign off in different language. If you can relate to them and respond to them with their way of thinking and their type of language, the endorsement that you get back is quite surprising, actually, and how they will then spread the word. We've always known, really, that friends and family, especially in financial services, is the primary source of trust and recommendation. In a social world, that's playing out too, like it's on fire to the exponential when you've got these trusted people who you've never met providing you with insight. And the more there are, the more social proofing there is. So if you're playing in those, well, you need to, bottom line is you need to be in those environments and in those forums, participating in the conversation, both positive and negatively. And you'll find as well, the more negative comments that you respond to in an honest and open way, ends up being better for your business than just saying thanks to the positive ones.
Yeah, and I agree with Andrew's point, if I can just touch on that a bit more. So that same ASX investor study that was done this year, we saw that over 50% of people are getting their sources from within their community. So that's friends and family or via social media. And that's at a click of a button at no cost. From our interaction with our clients, we've seen the same trends. It's never been so accessible to obtain information and opinions about companies as it is today. So these communities that Andrew touched on, they're being built on the social media platforms. They kind of replacing the traditional investment clubs. So through Facebook groups and Reddit communities, some communities being in excess of 1 million people constantly discussing market trend, company-specific news and opinions. You know, the next-gen investors, they're not really waiting for the physical newspaper to come out with the previous day's news. They have the same real-time news and announcement from companies and governments that only the select few financial professionals used to have in the past. You know, today an announcement by a company or by the government is released on Twitter at the exact same time that it's released on a Bloomberg terminal.
Yeah, there was a recent article came out of the States, I think it was yesterday, being Wednesday the 16th, that there are firms who are now curating all the recommendations and sentiment within these platforms. Here we are talking about Robinhood. There was a site called Robin Tracker that actually tracked the stocks that people in Robinhood were buying and selling. And there's another one based on Reddit that was mentioned yesterday. So it's very interesting that different models, it's almost like the travel.com, you know, the people creating all the different travel sites and coming up with one recommendation. So similar things are happening in the recommendation space for stock. And to Brad's point, if you go on Twitter and you put a $sign in and then the code of the stock, you will have hundreds, if not thousands, of responses back in 2 seconds about everything that's written, said, talked about a particular stock. And to Brad's point, you can't get that in the traditional media.
Yeah, I'm keen to talk more about different forms of social media, but before we jump onto that one, do you think this talks to a lack of access to advice, or is it just something that there's so much information now, it's available on demand, I'm going to go there? Because there's still a lot of advisors out there. You know, obviously there's a generational change going on. There's a handover, you know, handing down from one generation to another of wealth. Do you think it's just driven by accessibility and access to information in it, or is there becoming more and more of a lack of advice in the industry?
I'll jump into that one. I think bottom line is with advice and with direct trading, there is an attraction, and there always has been, with owning and buying something you can touch and feel. So when it comes to advice, I don't think advisors can ever compete with that. I think they need to cozy up next to it and be where these investors are and where they're talking, where they're chatting. Diversification is the key weapon against all of this, or the key defense against people blowing themselves up. The core tenets of advice and financial planning are really, really important around all of this. However, you'll never stop people going out and buying their own stocks. They want to touch it and feel it. They get instant gratification, instant pain if it goes down. But that instant feeling is the new generation. But advisors need to be there with the safety net almost, and either participate in these forums or participate or partner up with the online broking firms and provide this ancillary service for others when they don't think they need it initially, but they will realise that there are services they do need down the track. Also, to your point about wealth transfer, I think the baby boomers are now, well, what are they, 45? They're sort of 75 years old. And within the next 5 to 10 years, they'll be passing that wealth down to their kids who are now between 40 and 50. Millennials are driving a lot of this activity at the moment, but there'll be a lot of wealth given to the current 40 to 50-year-olds who have been paying down their mortgages, in paying with school fees if they have school fees. In the hardest period of their life, as they head into their 50s, they'll be extremely wealthy and a little bit more tech savvy than those who are 60 or 70 now today. So there will be, I know we've always talked about this wealth transfer for the last 15 years, but I actually really think it's happening in the next 5 to 10.
Right, let's talk about social media. We've seen a lot of references to Reddit lately, but even as recent as yesterday, there was an article in the AFR about, how Reddit, how it's becoming more prominent on Wall Street. Andrew, you've mentioned it here. Brad, you've coming in from an overseas market, South Africa, where Twitter has been much more heavily used over there than we've seen over here. Keen to hear your thoughts on that and what you've seen, how the Australian demographic compares to overseas.
Yeah, so we've we weren't so familiar with Reddit. We didn't use it much initially, and it's only been over the last year or so that we've started to see the traction that Reddit brings to the market, and through those communities that I spoke about. Twitter is a great source of instant information and discussions between people live. We haven't found that it's used as much in Australia, but it's definitely picking up. When we look on the world stage in other countries like America, when you've got the president tweeting every announcement he has, it's definitely going towards the main source of news and notifications to the world.
And Andrew, on your side, you've seen a lot coming out of Reddit, right?
Yeah, Reddit tends to be, it's where a forum can be created. I think where people want to go and get it, well, let's not call it advice, but either reinforcement of their own ideas or not, this sense of community. I think Twitter doesn't necessarily have that in Australia. It's more the once-off, self-proclaims journalist out there doing research. With the groups created, and ideas can go back and forth between individuals. It tends to be where I think there is a flock for online trading, at least.
Okay. So takeaways, it sounds like what you're saying is a blended sort of type of solution. Let me do it with you. We know investors are going to go to those sources. That's a growing trend. But those trends and those access, that information, those access portals that they get the information through isn't going to talk about portfolio diversification and sort of help them in their journey along the way as they plan for various stages of life. So is there some takeaways here? Maybe Brad, kicking off with you for the advice business. We've got a lot of listeners, who would be coming in from that angle, looking at this trend going, how do I fit into it? How do I make myself relevant? How do I leverage myself into that space?
Yeah, if I can just talk more about the social media point and how we see that with the investing. I think that the key driver is how integrated our lives have become with the listed companies that we engage with on a daily basis. You walk into Woolies, it's a very easy experience. We use scan and go. You prefer it compared to the competitors, and it's a reason to invest in Woolies. You walk out of the store, you open your app, and you buy some Woolies shares. It's easy. The same can be said with the benchmark, those US FANG stocks that are 100% part of our lives today. Those shares were never easily accessible. And now that people are integrated with them and they are accessible, there's a huge impetus to get a piece of the action.
Yeah, I think, Andrea, that's the one thing that advisors or the advice community needs to do or understand, I think, is that you can't take people away from investing in individual stocks. That's you can't say it's either or. Go into a managed fund or a managed account or some type of a managed solution, be all and end all against owning individual stocks. That's just not going to happen. There's too much of an attraction to that and the instant gratification, as we talked about earlier. I don't believe, and I've seen some negative sentiment to the advice industry participating or creating commentary in these forums. It's almost like an invader coming into a nice and cozy lounge room, trying to sell, Encyclopedia Britannica in your lounge room type of thing. However, they need to be, I don't think it's necessarily in those forums. I think they need to be in there to understand what the rhetoric, what's being said, but it's more going and partnering with the likes of Easy Equities or a Self-Wealth or a FinClear to partner up and be that safety net, that source of education and information when it's required, even when the end investor doesn't know they need it, rather than participate, be on a peer-to-peer basis in those social media forums.
Yeah, I think there's definitely that shift towards the digital portals. Advisors will start using robo-advisors more often to assist them in their financial planning for their clients. And like Andrew said, the fintechs actually enable their advisors to offer that wider range of products at a much lower cost to the investor. The millennials, they tend to be wanting more control and engaging with their finances more often than the general quarterly, biannual, annual meetings. That's normal in the advice business. But there'll always be a segment of the market that require financial advice. And on the ASX Investor Survey, about 63% of people said that they're open to receiving advice. A large percentage also said that they don't know how to find the right advisor. So that's probably a good spot for advisors to strategize on digital and engaging strategies to capture those clients.
And just while we're on the topic of advice, keen to also hear your views on sentiment. I mean, Andrew, you've got the wealth check score, built into Self-Wealth. There's a lot more sort of sentiment providers out there. Are you working with them? Are they looking to integrate more, again, along the same theme, where they're getting access to the community? So, for example, a company like TipRanks out there, where it's bringing in, sentiment from all over currently on US stocks. But are you seeing any changes in that space? People looking for more access to sentiment across the community?
Yeah, I think so, and that's represented in Self-Wealth's numbers a little bit. Self-Wealth actually started out as that community where people, not being a hot copper, not a forum for commentary, but more to see what other people were doing and to rank people's portfolios, really promote that diversification, that wealth check score, which is what Self-Wealth has, which how many stocks do you own, how many asset classes do you have, to stop yourself blowing yourselves up. And that's how we rank different investors within the community, so you can follow them and hopefully better invest. That was actually the initial IP and genesis of Self-Wealth, then morphed into the online broker, but still with that power behind it. We are seeing so much more interest in the Reddits and the Facebooks and all that commentary that Self-Wealth will turn its attention back to that next year. The data that we have on what the 100,000 plus community is doing, why they're buying stocks, why they're selling them, they can actually put their individual sentiment in. It's very powerful to actually sit back and look at that data. We will be moving towards more that next year to take advantage of that. What we call the premium subscription part of Self-Wealth, which you get for the first 90 days for free, is access to that. And that's been a low take up because we haven't promoted it and really sold it that well. But based on this extra feedback, based on the TipRanks and other the companies around the world, and the proliferation of this peer recommendation in social media, Self-Wealth's right to actually take its original IP and just put some bells and whistles on it and promote it more.
Yeah, if I can add, we see social media as one of our best marketing tools within our company. Over 60% of new registrations on our platform actually come through referrals, and that's just referrals within the community. We always encourage investors to share their trades on social media and engage with their community, and start discussions on these public forums, whether it's Twitter, Facebook groups, or Reddit. And it gives people more confidence, and it takes away that first hurdle of just getting onto the platform when you hear someone's story of how they did it and the lack of experience they had and how easy they found the experience.
So you're seeing a lot of that, Brad, where people are sharing through forums and that are sharing the trades after they've done them?
Yeah, so we have a piece of functionality on our platform that when you place a trade, we give you the ability to share that trade on different social media platforms. That trade's associated with a link, which is a referral link. So if I buy a share in Woolies, to go back to the example, I buy a share in Woolies, I say, hey, I just bought a share in Woolies on Easy Equities. It was a really easy experience. Use this link to go on and buy some shares yourself. And we've seen that within those communities, people are sharing these trades, sharing the ideas of their trades and the experiences that they've had on Easy Equities. And yeah, like I said, over 60% of all new clients come through those referral mechanisms.
Yeah, certainly a very powerful tool. We're seeing that across the board. So looking over at the US, we've got elections coming up. I think you both would be expecting to see quite a big uptake in volumes again. I know most online investing platforms are anticipating another upturn through that. Brad, Easy Equities, through your relationship with Drive Wealth, you've got, fractional investing in the US, and Andrew, we saw recently on the Self-Wealth announcement, that US is sort of in the next on the list. What are your gents' thoughts on the Robinhood effect? I mean, we've seen a lot of posts, even as recent as this week, and I've posted a few articles as well. Keen to hear your thoughts on, the zero brokerage model and Robinhood, and whether you think that's got legs, and whether you think that would one day have a presence in Australia. Excuse me. Maybe Brad, starting off with you.
Yeah, so I think if we talk about the users of Robinhood first, there's been a lot of talk about them not having experience and accessing these DIY products, which is dangerous. So Robinhood offers derivatives as well as options, which can be really risky. You can more money than you put in. So that's one of the dangers of Robinhood. But we've seen that these new age investors are actually really good at spotting these investing trends really early, since they engage more meaningfully and readily with these companies compared to the baby boomers. I mean, we also see that our clients understand the benefit of diversification without actually telling them to diversify. They are definitely diversifying. They're buying international shares, and some of their largest holdings are ETFs. So I think they don't get enough credit for their ability to invest. With all the news on social media, they're definitely better than they expected to be. On the actual Robinhood model, I mean, one investment phrase is there's no such thing as a free lunch. So I advise people to just look further and see at what point are they paying for their trades. And it might be over a period of time. It might not be a time of execution, but yeah, just keep aware of that.
Yeah, at some point you're going to get charged. Andrew, your thoughts?
Yeah, I think first thing you need to do is look at the Robinhood model. So to follow on from Brad's point, they make money in essence 4 ways. So yes, it's a $0 brokerage headline fee, but there are 4 different revenue streams predominantly that come through. The one that Brad mentioned, sort of the derivative side, which is more lucrative than traditional brokerage. The one that they talked about for the last 5 years, the 2 they talked about were margin lending and return on the cash account, the cash they hold on deposit. And that's all they mentioned until about 2 years ago, when they got fined for misleading information in regard to where the majority of their revenues were coming from. And I think it ended up being close to 50% came from where they actually siphoned off their trades. In the States, there is a market maker sort of model where you actually get paid for trade flow. So there are several different operators over there. So the more trades you can send to high frequency traders who make money off doing that, the more revenue you'll get back. So that's actually gone through the roof. As Robinhood has grown, so has the trade volume grown, and therefore their revenue. So they've now disclosed that is where the majority of their revenue comes from. Taking that, extrapolating that to the Australian market, considering that's close to 50%, if not more, of Robinhood's revenue in the States. The reason why Robinhood hasn't come to Australia yet, or other markets, is because we don't have that structure here. In my role at Self-Wealth 2 or 3 years ago, I was regularly speaking to Robinhood on a sort of a monthly, quarterly basis for them to assess the Australian market, ASIC, how the market works, and they were tiptoeing around how to enter the market, whether it was with the likes of a Self-Wealth on their own or under another structure, and they just put it into the too hard basket. You've seen what they've done recently in the UK, pulled out of entering that market. And with everything going on in the States with lawsuits and reputational damage, I think they're just looking after their own nest at home at the moment. Will $0 brokerage come to Australia? I don't think there's any doubt that it will. However, the ASX is going to have to come to the party as well. One of the reasons why I wanted to be consistent with my ethos back at Self-Wealth by creating flat fee brokerage, but that was almost impossible to get off the ground 3 or 4 years ago because the ASX have percentage-based fees, clearing component. So the bigger the trade, the more it costs the broker. So the concept of having zero brokerage in Australia without other revenue streams is loss leading. Unless you can create extreme volume straight away or loss lead for a significant period of time, it'll take a while before zero brokerage does come into Australia. That being said, COVID has brought a lot of different players to the market. Competition's great, a lot of different business models out there. We'll see which I encourage. I think it's great. Everyone can learn from each other, and so can the end investor. We'll work it out. We'll work out how to get to zero brokerage over time. Just be interested to see what model it'll be to enable that.
Yeah, agreed. I think you're right, Andrew. It's unless there's a structural change, it has to be under some form of loss leading, where it's subsidized as a marketing expense or something like that, because there's just too many underlying costs to deal with. Brad, anything from your side? Any thoughts on that? Or
I completely agree with Andrew, but Robinhood also should get a bit more recognition than they do get. Their latest funding rounds value them at over an $11 billion business. So, they're doing something right.
Absolutely.
So, there's a lot of bad news about them, but they have democratized investing and share trading in America, and they definitely are helping a lot of people. All those maybe posing risks to some, but they definitely are making a difference.
Yeah, interesting. Well, I think we're at 40 minutes, so we might leave it there. I haven't got any questions come through. But before we finish off, Andrew, notice you've got a keyboard behind you and probably a guitar next to you. There's a bit of a background there in your music career with the Wiggles involved. Maybe you just want to close us off on that little note and take us through that experience in your earlier days.
I thought it was a good webinar today. Anyway, in my earlier days up in Sydney, I used to play music professionally, and we support the Cockroaches. And I'll tell you what, I won't miss not hearing their songs again, but as they were transitioning out of rock band, they started to go into kids' music, and they asked me and the guys if we wanted to be part of their new kids' music involvement, and that turned out to be the Wiggles.
Incredible story.
Yeah.
Well, thank you, gents. Thank you. I think we're probably on the verge of losing Andrew, the bad connection. But thank you both for joining us. Really appreciate your insights and your time this morning. And thanks to all the listeners, and enjoy the rest of your day.
Thanks for having us on, Andrea. It's been great.
Thank you.
Thank you, Jeff. Great.